If you ignore the stock markets this week, honestly, you picked a great week to do it. Because investors had to deal with inflation worries, rising oil prices, a weakening rupee, a slowing China, major earning announcements, new government policies, AI developments, and one very stubborn market level that simply refused to break. But don't worry, over the next few minutes, we'll record everything that mattered this week. What moved markets, what moved the economy, and what could matter in the weeks ahead. Think of this as your weekly intelligence briefing. No endless charts, no complicated jargon, just the stories behind the numbers. Let's begin with the market itself because this week felt like watching a boxer repeatedly punching a wall, and eventually the wall was supposed to break and it cracked. So, what moved the markets this week? If I had to summarize the entire week in one sentence, it would be this: the market spent 4 days arguing with itself before finally making up its mind on Friday. For most of the week, Nifty remained trapped below the 24,200 levels. Every time it tried to move higher, sellers appeared. Monday, Tuesday, Wednesday, Thursday, the story remained almost identical. Identical. It's hard to pronounce. Buyers would push, sellers would resist, the markets would retreat and then try again. Now, if you're new to markets, here is something important. Markets are not simply collection of numbers, they are collection of expectations. Every trade represents somebody's opinion about the future. And for most of this week, investors simply couldn't agree on what the future looked like. What would inflation become a problem? Would oil prices keep rising? And would global uncertainty worsen? Nobody knew. And then markets don't know what to do, they often move sideways, and that's exactly what was happening. In fact, derivatives data showed that option traders had effectively built a battlefield around the index. The biggest resistance zone sat between 24,200 and 24,500. Meanwhile, the strong support existed around 24,000 levels. Think of it like a tug of war, one side pulling upwards and one side pulling downwards. Neither side able to win until Friday. Then something changed. The markets finally pushed through resistance, closing the week near its high and shifting the next major resistance zone towards higher around 24,700 to 24,800, while 24,200 itself became an important support level. That's a significant psychological shift. A level that spent 4 days acting on a ceiling suddenly became a floor. And markets pay attention to those moments because they often tell us where confidence is moving. Now, let's talk about the sectors because not every part of the market experienced this in the same way. IT emerged as one of the strongest sectors, winning 3 trading sessions during the week. Private banks also finished the week strongly and helped drive Friday's breakout. On the other hand, reality stocks struggled. PSU banks remained under pressure, and several rate sensitive sectors showed signs of caution. Which brings us to one of the biggest stories of the week: Rupee and oil. Because these two quietly influenced almost everything. The Indian rupee experienced its sharpest weekly decline since May. On Tuesday alone, it lost 62 paise against dollar and eventually closed under around 96.28 per US dollars. Now you might wonder, why does that even matter? Because India imports a large amount of crude oil and crude oil wasn't exactly behaving itself this week. Brent crude rose nearly 13% during the week. When oil becomes more expensive and the rupee becomes weaker at the same time, importing energy becomes even more costly. And that creates a chain reaction: high import cost, high business expenses, potential inflation pressure, and eventually concerns about interest rates. One event and there are many consequences. This is one of the most useful lessons in economics. Nothing exists in isolation. A move in oil affects currencies, currencies affect imports, imports affect inflation, inflation affects interest rates, and interest rates affect markets. Everything is connected. Which brings us perfectly to the next chapter, the economy's health report. And this week it delivered a very interesting message. If markets spend the week debating the future, economic data spent the week sending mixed signals. Let's start with inflation. Retail inflation measured through CPI rose to 4.38%, and now that doesn't sound particularly alarming, but wholesale inflation told a very different story. WPI inflation surged to 9.87%, and that's where economists started paying attention. Economists started paying attention. Here's why. Consumer inflation tells us what ordinary people are paying. Wholesale inflation tells us what producers and businesses are paying. When wholesale inflation rises much faster than consumer inflation, it often suggests that businesses are absorbing higher costs before passing them on. Think of wholesale inflation as pressure building behind it. The question is whether that pressure eventually reaches consumers, and that's exactly what policymakers will be watching closely. Now, inflation wasn't the only concern. Indian trade deficit widened sharply. Exports came into at $40.41 billion. Imports reached $70 billion. The result is a trade deficit of $30 billion, nearly 59% higher than the same period last year. And this connects it directly to the rupee story we discussed earlier. Higher imports mean more dollar leaving the country. More demands for dollar often puts pressure on the domestic currency, which helps explain some of the rupee weaknesses we saw during the week. Now, at this point, the picture sounds fairly negative. Higher inflation, wider trade deficit, weakening currency, and here's where the story became interesting because other part of the economy looked surprisingly resilient. Indian foreign exchange reserves increased to approximately $675 billion. Service activity remained healthy, corporate tax collections continued growing, employment indicators remained relatively stable. So, which story should investors believe? The warning sign or the positive signals? The answer is both. Recall the true, real economies are rarely simple. In fact, one of the biggest mistakes people make is expecting economic data to tell one clear story. It almost never does. Healthy economies still have problems, weak economies still have strengths. The skill lies in identifying which forces are becoming stronger. And right now, the data suggests that while pressures are rising, economic activity itself remains relatively resilient. There is another reason this resilience stood out: China. Because while India was debating inflation, China was dealing with slowing growth. China's GDP growth slowed from 5% to 4.3%, its weakest pace since late 2022. Now, why should Indian investors care? Because global investors are always comparing countries. Money doesn't ask, is India perfect? Money asks where the opportunity is better. And this week, despite its challenge, India continued to look relatively stronger than any major economies. That doesn't mean everything is perfect, far from it, but in a world filled with uncertainty, relative strength matters, and that's exactly why markets managed to break higher despite a week full of concerns. Because investors weren't just looking at the problems, they were also looking at the resilience. And next, we'll move from today's economy to tomorrow's economy because this week the government made several major bets on India's future, from semiconductors and manufacturing to trade agreements and infrastructure projects. And some of these decisions could influence markets longer after the week's headline disappear. Talking about the economy of India, which is trying to build for tomorrow, because while markets were busy reacting to inflation, earnings, and oil prices, policymakers were quietly making decisions that could shape the next decade. And the biggest announcement of the week came from a tiny object that most people never think about: a semiconductor chip. This week, the government approved the second phase of the Indian semiconductor mission, commonly called Semicon 2.0. The allocation, more than 1.27 lakh crore rupees. Now, that's a huge number, but more importantly, it tells us about what India is trying to achieve. For decades, countries largely competed over resources like oil, manufacturing capacity, or labor cost. Today, another resource is at the center of global competition: computing power. And computing power begins with chips. Your phone uses them, your laptop uses them, electric vehicles uses them, modern defense system uses them, and even major AI model running today depends on enormous quantities of advanced semiconductors. In simple terms, if AI is the brain of the future, semiconductors are the neurons. What's particular increasing is that this isn't just another announcement. Some projects approved under the first phase have already entered commercial production, which means India is slowly moving from planning to execution. And in economics, execution is what matters. This wasn't the only policy development this week. India's trade agreement with the United Kingdom officially came into force. The agreement aims to improve trade access between two major countries and could benefit sectors ranging from manufacturing to services over the coming years. The government also announced new railway and maritime infrastructure projects, reinforcing a trend we have seen repeatedly over the last few years. India continues to invest heavily in logistics and connectivity. Now, here's something many people missed. The government also adjusted windfall taxes. Export duties on diesel increased from 8.5 rupees per litre to 15.5 rupees per litre. Aviation turbine fuel duties rose from 7 to about 14.5 rupees per litre. Meanwhile, petrol export duty was reduced from 4 rupees to 2.5 rupees per litre. Not the flashiest headline, but an important reminder that government continuously adjusts policies in response to changing commodity markets. And with oil prices becoming volatile again, these decisions do matter. Taken together, the week's policy actions tell a fairly clear story. India went to manufacture more, export more, build more, and reduce strategic dependence where possible. Whether it's chips, infrastructure, or trade partnerships, the direction is becoming increasingly obvious. But policy is only one side of the story, the other side is business, and this week businesses had to say a lot because earning session arrived in full force. If stock markets are built on expectations, earning seasons is where those expectations meet reality. And this week gave investors plenty to analyze. Let's begin with technology because IT was one of the strongest sectors in the market. HCLTech reported strong results and healthy growth. Tech Mahindra also delivered numbers that investors largely appreciated. But not every company enjoyed the same reaction. Wipro's performance appeared considerably weaker compared to some of its peers, highlighting the uneven nature of the current technology cycle. And this is worth remembering. When people say the IT sector is doing well or the IT sector is struggling, reality is usually more complicated. Industries don't move as one giant block. Some companies execute better, some adapt faster, and eventually those differences show up in earnings. Moving to banking and financial services, several companies delivered impressive numbers. Federal Bank reported strong growth, Union Bank posted healthy profits, HDFC Life maintained positive momentum, but one company stood out because many viewers will already know it. Groww. The investment platform reported profit growth of roughly 94% year on year. That's the kind of growth figure that immediately gets investors' attention. At the same time, not every financial company had a great quarter. ICICI Lombard reported a profit decline of around 46%, providing an important reminder that earnings season rarely produces winners across the board. Now let's move to the industrial side of the economy. And this is where most of the most interesting stories emerge from. JSW Steel reported profit growth of more than 100%. BHEL returned to profitability after previous reporting losses. Those are significant development because turnaround stories often attract enormous investor attention. Market loves growth but markets absolutely love recovery. Then came an interesting comparison in the electrical equipment space. Polycab reported profit growth of around 32%. Havels, on the other hand, saw profit declines roughly 16%. Same country, same broad economic environment, very different outcomes. It's a useful reminder that company performance often depends less on the economy itself and more on the execution within that economy. Now, while companies were reporting results, many were also making major strategic moves. Let's look at the biggest deals of the week. The headline deal came from Grazium. The company agreed to acquire Shell's Spring Energy business in a transaction worth approximately 17,200 crore rupees. That's not just a large acquisition, it's another signal that renewable energy remains a major investment theme. Adani continues strengthening its defense presence through a new development in the sector. Tata Capital expanded into the gold loan markets. HCLTech announced the acquisition of Guardian India operations as part of a broader strategic partnership, and then there was fundraising because growth often requires capital. Several major companies tapped capital markets this week. SBI, Tata Capital, Tata Power, NTPC Green Energy, and Ether Energy were among the names pursuing significant fundraising initiatives. If there is one theme connecting many of those corporate actions, it's confidence. Companies don't raise capital, acquire businesses, expand into new segments, and invest aggressively when they expect stagnation. They do it when they see opportunity. And despite all the concerns surrounding inflation, oil, and global certainty, corporate India continues to invest heavily in the future. Which brings us to perhaps the most fascinating part of the week. Because while India was focusing on earnings and growth, the rest of the world was having a very different conversation. A conversation about oil, artificial intelligence, and whether investors have become a little too optimistic. Now let's zoom out because markets don't operate in isolation. Money moves globally, capital moves globally, and increasingly technology moves globally. And this week, the rest of the world has focused on three big questions. Will oil remain expensive? Is China's slowdown becoming a concern? And perhaps most importantly, has the AI trade become too crowded? Let's begin with oil, because whether you are an investor, a business owner, or simply someone paying for fuel and oil eventually find its way into your life. This week, Brent crude snugged nearly 13%, one of its strongest weekly moves in recent months. Now, oil prices don't just affect petrol pumps, they affect transportation, manufacturing, airlines, logistics, imports, inflation, and ultimately economic growth. Which is exactly why investors spent much of the week paying close attention to energy markets. At the same time, another major economy was sending warning signals. China. China's GDP growth slowed to 4.3%, down from 5% previously and making its weakest pace since late 2022. Now, whenever China slows, the world pays attention because China remains one of the largest consumers of commodities and one of the biggest drivers of global manufacturing demand. A slower China doesn't automatically mean a weaker world economy, but it does change expectations, and markets care deeply about expectations. In fact, if there is one lesson this entire week taught us, it's this. Markets don't react to today's reality, they react to tomorrow's possibility, and nowhere was that more visible than in technology. The AI paradox. For nearly 2 years, artificial intelligence has been the biggest story in global markets. Companies have invested billions, governments have invested billions, investors have poured enormous amounts of money into anything connected to AI. And for a while, that strategy worked extremely well. But this week, something interesting happened. Several technology companies delivered strong numbers, yet many AI linked stocks still struggle. At first glance, this seems confusing, like shouldn't good results push stocks higher? But not always, because stocks don't compete against reality. They compete against expectations, and expectations around AI have become enormous. Think about it this way that imagine a student consistently scoring 99 out of 100. If they score 98 next time, that's still an incredible result, but people may still feel disappointed. Not because the result was bad eventually, but because the expectations became unrealistic. That's what's happening in parts of the AI market today. The debate is no longer whether AI matters. Most investors are agreeing that it does. The debate is whether current valuations already assume a year of future success. And that distinction matters. Because a great technology doesn't automatically mean every stock connected to it is a great investment. History teaches these lessons repeatedly. Railways transformed transportation, the internet transformed communication, smartphones transformed daily life. But not every company associated with those revolutions succeeded. The winners were often different from the early favorites. Now here's the part when people miss it, just simply miss it. While investors debated AI evaluations, companies continued investing aggressively. LCI Mindtree revealed that its AI-related businesses has reached approximately 150 billion million dollars run rate. Its leadership also highlighted something fascinating. The problem isn't lack of AI demand. The problem is a shortage of skilled people who can effectively work with AI. And that may be one of the most important signals of the entire week. Every major technology revolution creates a race, not just for technology but for talent. And right now, the race is accelerating. Speaking of investors, one comment this week attracted significant attention. Warren Buffett once again warned about excessive speculations in short-dated option trading. His argument was simple: many participants aren't investing, they are simply gambling. Now, whether you agree with Buffett or not, Buffett. I'm sorry if I'm pronouncing that wrong. Warren Buffett. I hope that's Warren Buffett. His observations highlight something important. The easier markets become to access, the easier it becomes to confuse activity with skill, making frequent trade feels productive. Checking prices every few minutes feels productive, but investing and trading are not the same thing. And over the long term, discipline usually beats excitement. It's a lesson market regularly teaches, even if people rarely enjoy it. Now let's do a segment of quick fires, where we talk about deals, IPOs, capital markets. Before we wrap up, let's quickly cover a few developments that deserves your attention. Zwork received approval from SEBI for its public listing plans, means IPO. SBI Fund Management's issue witnessed extraordinary investors' demand, moving from just 0.68 times subscription early to a remarkable 41.66 times subscription by the close. Laser Power attracted strong interest as well, with subscription reaching approximately 38.94 times. Make My Trip India confidentially filed for an IPO, while JSW1 received approval for its planned offer for sale. And globally, corporate deal making remained active. Major acquisitions or discussions involving companies such as Stripe, Advent, PayPal, Uber Delivery Hero, and Eli Lilly reminded investors that despite economic uncertainty, businesses continue hunting for growth opportunities. Before we end, let's talk about one idea that stood out this week. Microsoft CEO Satya Nadella discussed something called the reverse information paradox. The concept sounds technical, but the implication is simple. Every time people interact with AI, they generate information. Every prompt, every correction, every question, every workflow, over time, AI systems learn from those interactions. And the result? Information is no longer valuable simply because it exists. What's valuable is the ability to learn, adapt, and apply knowledge faster than everyone else. Whether you are a company, an investor, or an individual professional, that's a trend worth paying attention to, because technology changes tools, but it also changes advantages. So, in the last final thoughts, what did this week actually tell us? The market spent 4 days fighting a resistance before finally breaking higher. The rupee weakened, oil surged, inflation heated up, the trade deficit widened, yet economic activity remained resilient. India doubled down on semiconductors, infrastructure, and manufacturing. Corporate earnings largely held up well. Businesses continued raising capitals and making acquisitions. China slowed. The world debated AI valuations. The investors continued searching for clues about what's coming next. If there is one takeaway from all of this, it's that we are living through multiple transitions at the same time: economic transitions, technological transitions, industrial transitions, market transitions. Most weeks simply give us headlines, but occasionally a week give us signals about where money is flowing, where government are investing, where businesses are expanding, and where the future might be heading. This was one of those weeks. And if you made it this far, congratulations. You have just saved yourself hours of reading, dozens of articles, countless market updates, and an entire week's worth of financial noise. Thank you for spending part of your Sunday with me. And as always, Stay curious, stay informed, and I'll see you next week, next Sunday, with a new episode of the Finance Sunday.